Welcome to Big Idea Investing. It's your host, Dylan Loomis. By now, you've probably seen that earlier this week, ARK's flagship fund, ARK, saw $456 million flow out of the fund, its largest daily outflow. This was 3 times larger than its previous worst day of $140 million. And according to the ETF database, the total outflows from all ARK funds was over $800 million. For context, this is only 1.4% of their roughly $55 billion in assets under management, but this brings up a lot of really important talking points for ARK Invest that it's now time we take a look at so we can all understand how to move forward. And if you don't think ARK deserves our attention, look at BlackRock, the biggest money manager on the planet. They just started a future tech ETF in September of last year where they seek to, quote, maximize total return by investing in companies developing innovative and emerging technologies in the technology sector. Sound familiar? It should, but their biggest holding, also Tesla, only makes up 1.88% of the fund's weight. The fund has $13.8 million in net assets and 111 holdings. ARK, on the other hand, ARK's flagship fund, has $18 billion in net assets and holds on average only between 35 and 55 underlying stocks. So what do we make of all of this? There are 2 polarizing views I'm seeing online. One camp saying the headlines are FUD and just buy as much as you can on the dips, ARK is going to the moon, and the other camp is saying how ARK funds are going to zero due to an eventual liquidity crisis stemming from their decisions to own upwards of 20% of certain companies. But of course, the answer probably lies in the middle, so let's nuance this out so we can make wise, informed decisions. And then what do we make of tweets like this, where the Wall Street Journal does mention ARK owning almost 50% of ARK in small companies where they own 10% or more of each company? Because it is true that things like this can cause predatory short sellers to pile on as they await massive fund outflows to create a death spiral and self-fulfilling prophecies where this downward selling pressure can cause the ETF to trade below the net asset value, which leads to redemptions and a host of other things we will get to. But 3 quick points that should go without saying, but in today's world, I know they don't. Investing in an actively managed ARK fund is still an aggressive, risky investment despite it being labeled as an ETF. Second, you should not be investing into ARK funds unless you share the same timelines as Kathy and team, which is a minimum of 3 years and more often 5 to 10 years. Disruptive innovation companies and technology don't disrupt overnight. It takes years to play out. I don't know anyone who would pay to go see a movie and then only stay for the first 20 minutes. And third, if you are investing into ARK funds expecting 3-figure returns every year, please internalize that past performance is no guarantee of future returns. It's the oldest saying in the book, but so many retail investors new to investing need to hear me say, ARK is not going to generate 150% returns every year, period. Will they have more years like that over the next decade? Yes, probably, but they will have far more that don't come close to 100% returns. And it's true that the bigger they get, the harder it will be for them to maintain above average returns, and you will understand why before the end of this video. First up, remember this throughout the episode. ARK funds are fully invested and do not hold a material amount of cash. ARK generally will not use cash in a tactical manner. This is directly from their website. But moving on, when funds grow their assets, they need to then invest bigger dollar amounts into the underlying stocks to make up the same portfolio weightings. To illustrate, a fund with $1,000 in AUM or assets under management would need to invest $100 to hit a 10% portfolio weighting target, whereas a fund with $10,000 in AUM would need to invest $1,000. Simple stuff. But this leads to issues when it comes to buying smaller underlying companies. Warren Buffett's fund can't touch mid-cap stocks because any meaningful allocation would mean owning a significant part of the company, and as we know, most growth typically comes from the smaller size companies. So as fund management companies scale, some of the smaller companies are taken off the table as an investment option. But take a breath. In the grand scheme of things, ARK is not that big yet. BlackRock has over $2 trillion in assets under management, and Vanguard is also approaching that $2 trillion mark. But as we saw, ARK is in the $50 to $60 billion AUM range, so they're nowhere near these companies, but they have been the fastest growing fund management brand, and if that trend continues, it won't be too terribly long before liquidity does become an issue. Liquidity is just the ease of buying and selling shares, and in green markets, it's generally not a problem. But when markets go through corrections and downturns for smaller companies where daily trading volumes are not that big, it becomes difficult for a fund manager like ARK with big positions to close out of a specific position, and it can sometimes take several days. And our guy Nate, go follow him if you're not, showed us ARK currently owns more than 10% of 25 different companies. And at the top of this list, ARK's ownership percentage is over 20%. Remember, in up markets, this isn't that big of a deal, and we know there are thousands of rookie investors just blindly buying whatever ARK buys. If that's you, don't take any offense. It will work out great in bull cycles as the positive feedback loop plays out. ARK buys, thousands of others then follow suit, driving up the prices. Everyone wins. But what happens when the next 2008 market comes around? I'm not saying it's coming soon, but it is coming eventually. And you guessed it, the reverse feedback loop plays out, causing more downward selling pressure. And there is something called ETF plumbing. It's pretty controversial, but it does have to do with liquidity in down markets. But simply put, if people are pulling money out of ARK, ARK has to go sell the underlying assets in the fund as they don't hold cash. But sometimes people sell shares of ARK faster than ARK can actually sell the underlying assets, which is what we call a liquidity mismatch, selling the fund faster than you can sell some of the stocks inside the fund. And if you want to look at a real world historical case study where these concerns are coming from, go look up Neil Woodford. He was a rock star fund manager in the UK, much like Warren Buffett and now Cathie Wood in the United States. Long story short, he started his own fund, it took off, but he was investing in some stocks that were not even listed on the stock market, smaller companies, making them illiquid. It was an open-ended fund like ARK ETFs, meaning that if money flows out, they have to sell the stocks. Ultimately, Woodford announced to investors they couldn't pull out their money, and the fund was gated in an attempt to give Woodford time to unwind their less liquid holdings slowly to replace them with more liquid investments. But back to ARK. One company that ARK holds gets a lot of attention as a potential liquidity crisis, Invitae, held in ARK. ARK holds 16.9 million shares, which is only about 2.8% of ARK. So what's the big deal? Well, if we go to Nasdaq.com, the average daily trading volume of Invitae, a smaller company, is about 3.1 million shares. This means it would take over 5 days to unwind this position with normal trading volumes. So yes, on the upside, this is great. Owning bigger percentages of small companies when they go up in price is a good thing, but it can be very painful on the downside as you have to ask who will be there on the other side to take that side of the big sell order trades. And here are some of the names of the least liquid stocks that ARK owns. Typically, these are the stocks that would be sold last in the event of massive outflows from ARK. But look, it's true, most of the time ARK does not need to unwind an entire position immediately. As people withdraw money from the fund, they can make active decisions based on where to pull money from first, which is, by the way, what you are paying them to do when you invest with them. Their 10 times growth of assets under management last year will lead to a new set of challenges for ARK, as this will undoubtedly lead to much bigger outflows and thus ARK needing to liquidate certain holdings to keep up with the fund flows. Any fund manager that scales and grows faces the exact same challenges. It's just discussed more often with ARK because of their popularity and the retail interest in what the ARK team is doing. With that said though, ARK does have inherently more risk because they'll take bigger inflows and allocate them across fewer investments than other companies like BlackRock, which you'll see momentarily. And they are one of the first concentrated, actively managed ETFs that have seen explosive growth in such a short amount of time. So what can ARK do? Option 1 would be to increase the number of holdings in their portfolios to dilute the weightings of each stock, deploying capital to the next best idea strategy, which of course, like everything in this space, comes with trade-offs, as this is one big dance of risk and reward. Another option would be to slowly wind down positions of smaller companies while building up their positions in the bigger, more liquid companies, which by the way is seemingly a big part of what they've been doing, as they've been buying companies like Lockheed Martin, Baidu, Zoom, Nvidia, and Tesla, and selling companies like Pacific Biosciences, X1, Organovo, and others. So this is where things get interesting. Is ARK buying and selling because of liquidity and portfolio weighting strategies, or because of underlying company fundamentals? Without explicit commentary from ARK, we are all just speculating. Locking in profits and reallocating to depressed stocks is investing 101, which is what any good fund manager executes over time. And this is part of why just following them blindly won't always work out, because if you take it as the wrong signal general, it's not going to work out in your favor. But we do have some insight, as Kathy has said publicly, as markets rise, ARK diversifies into larger companies, forming a war chest ARK can tap into during downturns when less liquid stocks will be hit disproportionately, giving them better bargains. And most of us know by now there is a knee-jerk reaction to anything ARK even makes mention of. ARK announces a space ETF and the space stocks jump double digits right after the headlines make their way around. And we can be sure the same symmetry will take place when ARK becomes less bullish on certain companies. So the big takeaways here: ARK is a full-blown media hype rockstar investing team. We love their research, we love their approach, we love their strategy, and we love the returns they've generated as of late. But there are some people new to investing that have not yet seen a bear market, and when it comes, they are going to panic. There will be millions of weak-handed money flying into ARK funds due to FOMO, and as soon as they see a new shiny investment elsewhere, they will pull it right back out because a huge percentage of people today have ridiculously little patience and don't actually know that what they are doing is not investing, it's gambling. And the truth is, ARK does indeed carry more inherent risk from their portfolio weighting decisions. Go look at almost any BlackRock actively managed ETF and you will find that in terms of net assets or AUM relative to the number of underlying holdings, ARK Invest will frequently have more money allocated across much fewer investments than BlackRock and other asset managers. This is absolutely something to be aware of and to know before investing in ARK. But remember, time in the market always beats timing the market. This is why I base this channel on research, as I want everyone who watches to learn to slow down and understand the market, understand how ETFs work, understand the real world examples where very similar situations have gone south very quickly. Not to live in fear, but to be educated and make more winning decisions than losing ones over the course of an investing lifetime. So these outflows are a record outflow for ARK, yes, but they are only a small percent, between 1 to 3% of their fund holdings, far from some sort of huge warning sign in my opinion. With interest rates creeping back up, Tesla and Bitcoin FUD, weak economic data, and a host of other factors, seeing risk being taken off the table like this should not come as a surprise. I personally am not worried one bit about ARK being naive to these liquidity concerns, and I do trust them to handle large outflows as best as they can. That said, I do not think they are bulletproof by any stretch, and in the event of the next 2008 market, whenever that time may come, people that don't understand the inherent risk in ARK's weightings are going to panic and panic sell at the worst time. But as long as you have 5 to 10 year plus time horizons, you have no need to worry, no need to panic, as you can comfortably ride out the downturns. So yes, be aware of ARK's allocation strategy and know that it is not really common what they are doing with their portfolio weighting, having big money spread across very few investments relative to other big investment managers. But this is not inherently a need to worry, not yet. So be sure to subscribe in case this does change. But thank you guys for watching until the end of the video. Please take a moment to like it if you did. Consider subscribing for more investing content, and I hope to see you in the next video. I hope that you have a great day.